Hello, everybody, and welcome yet again to another fun video here of more accounting after dark because it is getting close to the witching hour. It's almost midnight. Well, let's go ahead and have some fun, and because it's always fun to have fun, let's go through and take a look at this. We're now going to be looking at part two, which we're going to be looking at our activity ratios, which are also sometimes known as efficiency ratios, as well as turnover ratios. And in this journey to accounting after dark, my disclaimer and copyright notice, the information and opinions in this presentation are those of myself and not my employers or affiliated organizations, including but not limited to Irvine Valley College and the South Orange County Community College District. The presentation is for educational purposes only. It does not constitute any legal or accounting advice whatsoever. This presentation is copyright 2008 to 2025 by Bennett Tchaikovsky. All rights are reserved. Any distribution is strictly prohibited. So we're going to go ahead and do the same thing for Five Below, but before we get to that, let's take a look at the activity ratios. These can be incredibly important because what they're going to be telling us is, for instance, how quickly are we turning over our inventory, meaning if we want to be turning over our inventory as quickly as possible, especially if we're in something like an electronics retailer. Why is that? It's because if we don't turn over our inventory quickly, we may risk the inventory becoming obsolete. So we want to be turning this over as quickly as possible. So the way we're going to figure this out is we're going to take our cost of goods sold and divide it by our average inventory. So let's go ahead and do this for Five Below. One of the things you'll see that I've added to this, and if you're taking one of my classes, we're going to come up with a summary page. And as you see from the prior video, when we did the liquidity, we're going to show our calculations over here, but we're going to put our summary over here. And if you're doing this for more than one company, then of course you'd be adding your other companies right over here. But let's take a look at our activity ratios. So for this first one here for inventory turnover, we're going to be taking our cost of goods sold, which we're going to go ahead and get from our income statement. And we'll go ahead and pull this over here from the five income statement. And this was what it was for the year ended February 1st, 2025. And this was for the year ended February 3rd, 2024. Now we need to figure out what is our average inventory. Well, our average inventory as of 2/1, our inventory balance as of 2/1/25 to 3/24. And then if we look at the balance sheet, it was 1/28/23. So my inventory balance on February 1st, 2025 was $659,500. For 2/3/24, it was $584,627. And then for 1/28/23, it was $527,720. So what does this mean? Well, it means that my average inventory over here is going to be the sum of these two values, right? So for 2/1/25, it's my beginning inventory plus my ending inventory. But to get the average, we're going to divide that by 2. So this is how we come up with our average inventory. And we're going to go ahead and do the same exact thing over here for 2024. We're going to take the ending inventory of 584,627, add it to our beginning. We're going to divide that by 2. And our average inventory over here is going to be at 556,173. So now that we have those values, what we're now going to go ahead and do is take our cost of goods sold and divide it by the average inventory. We'll do this for both of these periods of time. So when we look at our inventory turnover, our inventory is turning over currently about 4 times per year. And then this is turning over about 4.1 times per year. Okay, now, when we look at these numbers, right? This doesn't really, it's like, well, when I think 4 times per year, but really what I want to know about this is in terms of days. So in terms of what we call days sales and inventory, we're going to take 365 and we're going to divide this by our inventory turnover ratio. And what this is going to tell me is the number of days it's going through and taking me to essentially to convert my inventory into cost of goods sold. So for my days sales and inventory, this is roughly about 90 days, and this is going to be roughly about 89 days. Now, again, if we were looking at this, wanting to compare it, we would basically look at, well, what's another, if I looked at Dollar General, if I looked at Dollar Tree, if I look at another competitor, what is that going through and taking? So, but this is how we go through and compute the day sales and inventory and the inventory turnover ratio. What I'm now going to go ahead and do is I'm going to add this to my summary. So I'll put over here, my inventory turnover ratio is 4.06 and it was 4.11. My day sales inventory are at 90 days. And then over here, it's at 89 days. I want these numbers, this number here to be as low as possible because the faster it's turning over, the better. Now, when it comes to days, the accounts receivable turnover ratio. Well, guess what? This is an activity ratio, and I listed it here because I am listing it here. But if we look at the balance sheet, do we see anything with accounts receivable? And the answer to that is a big no. So for us, in our particular example, what we're going to be doing here is putting a big not applicable, no accounts receivable. Now, I also want to mention something here as well that's very, very important to note. Okay, is that you have to come up with net credit sales. And I want to look at this slide really carefully. So when I come over here, the accounts receivable turnover ratio measures how efficiently a company collects payments from its credit customers. It shows how many times on average the company collects its AR during a specific period, usually a year. It's the net credit sales divided by the average accounts receivable, and it excludes cash sales. When you're doing this for publicly traded companies, it may be very difficult to find out, well, of the net sales, how much was cash and how much of this was not. So if you are having to do this ratio, be really careful to try to understand is like, well, are there cash sales in this net credit sales? So again, it's something you want to kind of keep in mind as you're going through and doing this. Is a credit card sale the same as a cash sale? Maybe, maybe not, but it's something that you'd want to go through and explore. But again, if we're really looking at the true definition, it excludes cash. So you're going to have to find this number, which may be very difficult to do in a financial statement. Now, if we had an AR turnover, we would also want to be computing days sales outstanding. Why is this important? It's taking this AR turnover number and computing it into the number of days it's taking us to collect payment from our customers after a sale. It's telling us how efficiently our company is managing our accounts receivable. So again, for my example here of Five Below, it's not applicable. We don't have accounts receivable. Just put in NA, not applicable. For the accounts payable turnover, the accounts payable ratios, we have something called accounts payable turnover and then days payable outstanding. And this is something we are going to go through and compute. So let's go back over here to our Five Below. Now we've made our lives a little bit easier because we know what the cost of goods sold was because we had to use that to compute it for our inventory turnover ratio. But now we're going to have to go through and figure out, well, what was our average accounts payable? So for as of 2/1/25, our accounts payable over here was 263.43. Our average accounts payable was 256, and then our average accounts payable was 221,120. Why is that so important? Because I need to compute the average accounts payable. So let's go ahead and make, again, our lives a little bit easier by doing that fun copy and paste. So we're going to be taking these two amounts over here, dividing it by 2, taking these two amounts over here, dividing it by 2, and that's going to be our average accounts payable. What is average accounts payable? It is my ending accounts payable plus my beginning accounts payable, which is the ending from the prior year. So let's go ahead now and take a look at this. Let's go ahead and compute this. So our average accounts payable is going to be 258,309. And then over here, this is going to be 238,698. So in terms of a ratio, this right over here is going to be 9.77 times. This is going to be 9.57 times. But similar to our days basic, similar to our inventory or turnover ratio, well, we see this is how long it's taking us to go through and to sell it. Well, let's go ahead and put this into a number that we can actually kind of better possibly relate to, which is going to be our days payable outstanding. So what this is going to be is going to be 365 divided by 9.77. This is going to be 365 divided by 9.58. What does this mean? It essentially means that we are going through and paying off our payables pretty quickly. Now, a company like Five Below, in order to get the discounted pricing that they may have, they may need to pay off their payables very, very quickly because they're probably squeezing their vendors pretty well, or maybe not squeezing them too hard, but they're definitely going to be getting some good bargains because of how much they sell their product for. So those vendors may want to get paid pretty quickly. So again, you're taking 365, dividing it by 9.77. And as we can kind of see over here, it's measuring the number of days the company takes to pay its suppliers after purchasing their goods or service. And it can also help assess how well we're basically doing our cash outflows. Now, the next thing we're going to go through and look at, so we've done basically inventory turnover, receivables turnover, and then accounts payable turnover. Now, what we're going to look at now is something called the cash conversion cycle. This is a metric that tells us how long it takes a company to convert basically our investments in inventory and other resources into cash flows from sales. Provides us insight into the efficiency of basically how are we doing in terms of like the time taken to sell inventory, collect receivables, and then to pay suppliers. And the way that we're doing this over here, this is going to be the days of inventory outstanding plus the days sales outstanding minus days payable outstanding. This is going to basically be the cash conversion cycle. So this is really telling us how many days are we, I don't call it stringing out our vendors for, although kind of that's essentially what it implies. Well, let's go ahead and compute this cash conversion cycle. So here for Five Below, right, this over here is going to be my days sales and inventory plus my days sales outstanding. So over here, the days sales outstanding, remember the DSO is not applicable, right? So this is going to be 90 minus 37, right? This is going to be 90 plus 0 minus 37. Or this over here is going to be 53. This is my cash conversion cycle. Over here, this is going to be 89 plus 0 minus 38. Again, that 0 is basically because of the days sales outstanding is not applicable to us. So I've got over here 51. So it's basically taking me about, 53 days. And let's read this again. 53 days to basically essentially go ahead to convert my investments into cash flows from sales. So let's go ahead now and update our scorecard. Let's go ahead and update our summary. So the AR turnover ratio is not applicable, no accounts receivable. So we're going to put this over here. My accounts payable turnover ratio is going to be at 9.77, 9.58. My days payable outstanding was 37 days. And over here, it's going to be 38 days. My cash conversion cycle is going to be at 53 days. And then here, it's going to be at 51 days. So again, when we're looking at these numbers, when you're going through and comparing your two publicly traded companies, you're going to be able to put some better flavoring behind this because you're going to be able to sit there and compare the two different companies. Let's go ahead and take a look at our fixed asset turnover ratio. So the fixed asset turnover ratio is measuring how efficiently a company is using its fixed assets like property, plant, and equipment to generate sales. It can be especially important for businesses in capital intensive industries where fixed assets represent a significant portion of total assets. And this one over here is going to basically be the higher the better. So let's take a look and do this for Five Below. So as we look at this for Five Below, the first thing we need to figure out is what is our net sales. So our net sales over here, if I come over to my Five Below income statement, 3 million or 3.8 billion, and this is going to be 3,559,000. So for my net fixed assets, this is going to be over here on my balance sheet. This is going to be my property and equipment net. And this over here is going to be okay. So my fixed asset turnover ratio is going to be 3 for 5, the most current period, and then 3.13 for the prior period. And again, is this going to be a good ratio or a bad ratio? Honestly, it depends. I'm not trying to intentionally avoid the question, but it's essentially we would need to go through, and as you're going through and doing this for your companies, you're going to be using this, say, the higher fixed asset turnover ratio means that we're using our fixed assets more efficiently. Since this is declining, but it's not vary by very much, you could say that maybe, well, we're not as efficient in using our fixed assets, although the difference here is pretty negligible. And in terms of it being negligible, if we looked at this in terms of a declines by 0.07, and if we wanted to try to look at it as a percent, it's only really declined by about 2, like basically 2%. So again, it seems to me to be pretty negligible. So let's go ahead and add this into our ratios over here. And right over there. Let's go ahead and take a look at our last one over here, the asset turnover ratio. So let's go ahead and take a look at this one again. Total sales, really the same thing as net sales. And then here we're going to be dividing this by average total assets. Okay. So we'll go ahead and do the same thing. Go ahead and use this as well. Okay, so my total assets here was 4.3 billion. My total assets here was about 3.8 billion. And my total assets over here was about 3.3 billion. So when I take 4.3 plus 3.8 billion divided by 2, I get 4.1 billion. When I take this over here of basically of 3.8 billion plus 3.3 billion, divide that by 2, I get 3.5 billion. Okay, so right over here, I go ahead and now divide this by average total assets. Okay. So again, this is slightly declining. I believe that the number we want to see is the higher on this one, the better. I'm using higher indicates that I'm using it's at my assets more efficiently to generate revenue. A lower ratio suggests underutilization of assets. Now, what I can also do over here as well is that one of the things I put this on some of my accounting videos previously, but one of the things I'm using is my AI for managerial accounting to kind of go through and help me out with this. But if I say over here, like, what is a good asset turnover ratio considered to be? So if we look at over here, retail services, technology, which Five Below falls into, we would want to see a higher turnover ratio. But again, this is really going to be depending upon, the companies you're going through and looking at, right? It's really talking about if you look at the ratio intuitively, it's my total sales here divided by my average total assets. So let's go ahead and add that into our summary. Okay. So that brings us to the conclusion of our activity ratios. And again, every company that you're going to look at is going to be different. But again, when you're looking at similar industries, you'll kind of see some similarities with the ratios. But that's why we kind of go through and do this, is to really kind of try to get a better comparison and doing a little bit of a deeper dive quantitatively. So I want to thank you for watching and being with me here today. Hopefully I didn't put you to sleep. It is right now, I think around 12:25. So we get this video up tomorrow, but in any or later this morning. I want to thank you for joining me. Please don't forget to like and subscribe. It always helps. If you have any questions, feel free to email me at 1812cpa@gmail.com. And I look forward to seeing you continue on your accounting journey. Have a great day.